Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician. We sure appreciate you giving us a few minutes of your time and watching this video. We like to share these thoughts with you each and every week on things that we found important from the week's investment allocation meeting. This week, we're going to talk a little bit about the economy, and Andrew's going to talk about precious metals. So we'll dig right in and talk a little bit about the economy, but we'll start with just kind of a high-level view of how we think about economic data and how it influences our investing. And you've heard us over time really encourage you to think about how them being two different things. The economy can be marching at a different pace in a different direction than the stock market from time to time. One little tangent that I would give is I think there's a little bit of a closer bond between what's happening in the economy and the bond market. But in any event, we really want to distinguish those. What's economic data and what is market activity, especially when we're talking about the GDP, which is really one of the bigger umbrella measures of how the overall economy is doing. But it's always backward looking because it's 30 days after the close of a quarter before we get an initial read on the GDP. And then we get a couple of revisions from them. But let's take a look at a couple different measures. And yet again, the third quarter here, as we've finalized really the most important and things like retail sales coming in, the expectation is that the third quarter is again going to be coming in fairly strong. The blue range on this chart shows you where the professional forecasters have been throughout this quarter. They've tend to hover around the 2% line. Keep that in mind because we're going to revisit that in the next chart. But that 2% line is really what this economy is capable of doing. When you take the labor force growth and our current productivity and put that together, 2% is really a realistic longer-term average. So they tend to hover around that. Some will be hotter, some will be colder. But the green line is a version that the Atlanta Fed puts out that takes in incoming data like retail sales and formulates what they expect the quarter to come in at. And so as of now, kind of look at the end of that green line, and we are coming above where that range of expectations has been from or throughout this entire quarter. And so really just some further context here, throughout this year, the discussion has been what level of landing would this economy have? The Fed went through a series of rate hikes in 2022 and 2023, and that was expected to slow down the economy. And the question was whether we would have a hard landing, the economy really kind of go into a recessionary type environment, or if we would have a soft landing and kind of float by with low to modest growth. And so even after we have these lag effects from the hikes, we're still looking at a no landing scenario where this economy continues to stay strong. In fact, again, we talked about that 2% number being what the trend line or our potential economic growth is. That's the gray shaded bar. And again, we are topping what that potential GDP would be. And keep in mind, these are all after inflation. We're looking at the real economic number, which is what matters. And we've only had 3 of the last 16 quarters actually be below trend. So a continually strong economy has been the theme. This certainly is part of how we have to think about our fixed income, continuing to see the economy stay strong. Give some pause to the Federal Reserve being as aggressive as they told us in September. So that's the economic data. I'll flip it over to Andrew to talk about precious metals.
All right, thank you, Adam. So we've spent a great deal of time on these market covers talking about the equity market, looking at different angles, the Mag 7, the leadership, the big names, the small names, breadth. Now we can finally shift our focus. And this week, we're going to start looking at commodities, specifically metal commodities, things like steel, silver, gold, copper, platinum. And these names are really these commodities really are starting to improve and really pick up their performance quite a bit. They've actually been fairly strong performers all year, but really over the last couple of weeks, we've really started seeing them kick into gear. And we wanted to highlight that move and discuss a common question we get is discussing the ownership or the need, or should we always have gold? Do we need gold bars and things like that, and the usage of commodities. The first chart I want to show you is looking at the year-to-date performance for a lot of the metals. So we can see silver is up about 49%, gold's up 38% on the year, copper 23%, and then we have some that have been less performers. Titanium is down 7%. Steel is down almost 10%. And so the strong black line there you'll see in the middle is looking at the broad commodity market. So what we want to know is it just seeing that we're really seeing all commodities are really seeing strong performance, whether it's energy, metals, or agricultural. And actually that's not been the case. The broad look at commodities have actually are down almost 11% on the year. So we really are seeing this group of commodities really are bucking that trend. And so, looking at the reason why we think this could be sustainable, looking at the next chart, is looking at a long term look at gold in the black line. And below that is looking at a ratio of gold to stocks. When this green line's going higher, it's telling us that gold prices are outpacing the rise in the stock market. When the line's going lower, it's telling us that stocks are showing more strength than gold. And what we often see with commodities, and especially gold, is that trends seem to persist. We can see that from 2000 all the way through about 2010, 2011, gold had a really strong performance, both in absolute terms of gold prices rising, but also they were outpacing the performance of the overall stock market. Then we saw that trend begin to decline for several years into about 2015, and gold was underperforming the stock market and declining in price. And then here recently, it's been increasing in value, but still not able to keep up with the overall stock market. And we often see that trends in gold do persist. Looking at a study going back a long time, going back into the 70s, when we start seeing gold rise for at least 260 days above its long-term average, that it only happens about 14% of the time, but it's produced about a 28% annual return. And telling us that when we start seeing gold rise, telling it's been rising for at least 260 days in this uptrend, that it typically continues to persist higher. Looking at the last time this happened, and that's where we are right now, about 260 days as of the recording of this video, that the last time was January 2020. 12 months later, gold was up about 24%. Before that, it was 2010, 2006, 2002, 1987, and 1979. So you can see, looking at these the last 5 times, we have to get back into the 1970s to find just 5. So it doesn't happen that often. And that's the type of environment we're starting to get into right now with gold. And we think that there is value in having some exposure to commodity markets. But the big caveat there is recognizing when they're in an uptrend, because it's just like when they're in an uptrend that can persist. When they're in a downtrend, that can also persist and continue on. So it's not necessarily something we want to own forever in all kinds of market environments. But when we start seeing these trends shift and start to see them really strengthen, that type of environment can continue. And we have had gold exposure within our portfolios in certain models for the bulk of this year. And it's something we continue to evaluate how much more we should add or pull back, or evaluate different risk and reward opportunities. But we just want to share this, that there are times when commodities like gold can be very advantageous, but there's also times where they very much can underperform owning an equity portfolio or a fixed income portfolio. And so we need to be smart and be fairly active with the type of exposure we take on to commodities, specifically precious metals, and more specifically, gold and silver. So right now it's looking pretty interesting, but that's not always been the case. And we continue to monitor the strength we're seeing right now in this corner of the commodity market.
Oh, thank you. Good and thorough as always. So I appreciate all of you giving us your time again. As always, we'll give you a reminder. If we can be of service, don't hesitate. Reach out 800-928-4001 or scan the QR code and book it electronically. Thank you. Have a great weekend.